All right, welcome back to the program. Dr. Hassan Mahmoud is joining me right now. He's the Director of Monetary Policy Department at the Central Bank of Nigeria, and we're looking at the MPC's January decisions. Dr. Mahmoud, welcome to the program. A happy new year that we saw on Tuesday, but officially,
Happy New Year. Thank you very much.
Happy New Year. Let's get started because some analysts are very furious with the Central Bank of Nigeria. Let me start there, yeah, because I've read a few articles, you know. In fact, some professors have written on it and even sent to me on WhatsApp.
Yeah.
You know, their thoughts and all of that. They are not happy that the MPC did raise interest rate to 17.5%. Their reason, or their reasons, one of which is to stifle credit. So I think I should start from asking, why did the MPC raise rates at this time? Bearing in mind that we saw an ease of inflation, headline inflation in December. Then you could talk about the other part later.
Yeah, thank you very much and Happy New Year to you and your entire team at the AIT. There were, you know, a long debate and justification of the policy choices of the MPC members around the facts that are underlining the development we see in the economy. But the central focus was, or the central point was the fact that what was the purpose of the initial, you know, drive to tightening? And the argument was that it was to rein in inflation, tame inflation, moderate inflation, expansion over the period because of the inimical effects of inflation on the real sector, the external sector, and other prices, exchange rate, interest rate, and stuff. So at the month-on-month inflation number for December, we saw a 13 basis point decline. Very good news. But if you look at the breakdown of those the information, the CPI, you'll see that the core component actually rose. The driver of the marginal decline you saw was coming in from a decline in food inflation. That's good in the sense that we've put in so much into, you know, driving food supply and all that, and as well as also, you know, pushing manufacturing output growth. But if you also look at the drivers of growth, manufacturing output contribution to growth also declined. And so that sector is actually in red, showing that yes, the stifling of credit was impacting on them. The cost of funds is also impacting on their businesses. But like I said, the central focus is how do we bring this inflation down, because we see the impact of that inflation on domestic disposable income of households and how that is affecting employment, standards of living. We see that also through the pass-through to other prices, exchange rate, and how that is also translating back to fueling inflation. We had the argument in the beginning that there was a pent-up demand. You know, there was a lot of money within the system, the supply was not meeting up to that level of demand, and those pent-up demand was pushing prices up, which was kind of demand pull inflation, and there was a need to tame that. That was also a global phenomenon. You know, every country in the world had that post-COVID because of the injections that came in through COVID. So we are trying to control that aggregate demand to make sure that the monetary phenomenon of inflation, which the monetary policy tools are most effective to address, are tamed, so that the supply side, which other sectors of the economy are players, fiscals and the private sector and all that are players, will be able to meet up with the level of demand that we can bring down, so that prices are stable or prices are coming down to a reasonable level. The rise, yes, there was a 13 basis point decline in month-on-month inflation, but year-on-year inflation is still 21.34, which is, you know, looking at our threshold of 6 to 9% is still more or less double of that number. If you also look at even the MPR that we had before this month-on-month inflation, 16.5, compare that to 21. You're still looking at 500 basis, more than 500 basis point difference of negative real interest rate, which you need to narrow to also drive domestic investment, boost up what they call national savings, so that you have investable funds to lend out as credit. We've also come to realize that the proportion of credit growth, you know, in macroprudential surveillance, when you see a rapid growth in credit that is not commensurate to the growth in the GDP, it's a bubble.
Yeah.
Meaning,
Okay.
you know,
Yes.
people are taking,
Yeah.
we saw it in America when they had
hot
the,
money.
yes.
Yeah.
So you see that growth, you know, in credit, and
Not hot money, helicopter money, you mean?
helicopter money, those
During
are
the
injections.
pandemic,
Those are injections that
okay,
we
so
do into
which
the
one do
economy.
you mean?
This one now is around when you see, it's just like seeing asset prices,
Okay, prices. Just
going
like,
up very fast,
just like what we
while
had in
growth is not
Nigeria.
going up.
Just like what we had in Nigeria during the, while the world was suffering, I think before even the stock market
Yes, crisis.
crisis.
2007,
we
we had
saw
something like
asset
that.
prices
Going up,
going up.
not commensurate.
Okay, that's actually what you mean.
Yes, that's
Yeah.
a bubble.
Yeah.
And what that bubble signals is that there's going to be a financial crisis coming. It's a signal that there's a financial crisis coming, and the financial crisis will lead to economic crisis, recessions, and all that economic downturn. So we also see that credit growth was like over 40% over this period. The supply side needs to meet up. We agree that yes, some of those credit were to get equipment, get machinery, tilt land, and all that. Bring in the gestation period of production could be 1 year, some could be 2 years if it's agriculture, maybe cash crop or things like that. Takes some time. We're talking of value addition, so some industries will have to be built up. So there's that lag, and you see that building up and fueling inflation. So the Monetary Policy Committee was also mindful of the fact that the tightening is already reflecting in our growth numbers. You know,
yes,
quarter on quarter, yes,
stifled.
yes.
And we discussed this in November.
Yes,
I specifically
we
asked
did.
you
Yes.
that question.
So
and
we've started seeing
when
it.
the numbers came out,
Yes.
I wasn't surprised.
Yes. So we've started seeing it. Most other economists, in short, in the analysis that was read out in the communique, 1/3 of the global economy are going to go into recession in 2023. The global growth was also revised downward to 1.7. The United States is even looking at growth of 0.5. Don't forget that they're also tightening. Inflation is already going down there, at least almost 3% now. They had close to 9 point something, they are at 6 point something now. So inflation is going down there faster than even
here.
Nigeria. They started tightening a lot earlier than us. Even with
Do you
inflation,
think that's why it's going down?
Yes.
Or their own monetary policy tools align better with their markets than ours?
well, they
the
have
transmission,
matured,
yes, the transmission
matured
mechanism.
economies. Transmission is a lot more efficient. Structural issues are a lot resolved in those environments. They're in a steady state equilibrium, they call it. But we started, and even with that decline in inflation, the United States has still promised to tighten this year at least 3 times in 2023. So the point is, we realize that there was a 13 basis point increase in inflation. That is not where we want to be. But yes, it's telling us that yes, maybe we've reached the plateau now. We're coming down the line. We need to consolidate on that and enable, at least 500, 600, 700 basis point decline in inflation. There are also predictions that many of the global economies will also experience sharp decline in their inflation numbers because this tightening has really helped in bringing down those numbers. So the members of the opinion that, okay, let's consolidate on this, let's hold the tightening. Governor gave reasons for loosening or holding and why that will be inimical to where we're going. We're not there yet. If we consolidate on what the gains we're getting now, so that both manufacturing component of inflation, core inflation and food inflation are going down simultaneously and at a significant proportion, then we can start thinking of, okay, let us relax. Now, what you also realize is that in the previous interest rate hike, we're doing 150 basis point and stuff. The gap is still very high in terms of the negative real interest rate margin. Ordinarily, you saw in the votes, a member voted for 150 basis point increase. I read some of the projections by analysts on TVs, including AIT, that were saying that they expect 200 basis points.
200 basis points?
200 basis points, yes. That was also mentioned that, okay, I'm saying we don't know what was informing those projections or the analysis behind that, but that
But
will
some
have
people
been
thought that
overhaught.
you or the members of the MPC will hold status quo.
Well, the point is, if you hold, what of if this inflation downturn reverses?
If it was
Then
just cosmetic,
Yes, so then the next
decline.
one, the hold that you have done now, the
Mm.
50 or 100% you didn't do now, you'll have to do that on top of another 100
And
basis
do it
point.
with a larger
Yes,
percentage.
aggressive, yes.
I'm trying to understand you guys as if I'm with the MPC members in the
Yes.
room, because I'm trying to also take a look at the analysis that, okay, if the central bank had held status quo position,
Yeah.
for instance, this was for a month, December, that showed inflation at 21.34%, and inflation I think this is like the first time in many years, really, apart from whether the pandemic,
Yeah.
when I think even during the pandemic, inflation rose in December because of demand. But this is like the first time in years that inflation declined in December,
Yes.
which is a festive
Period where inflation is projected to ensure the CBN
increase. So
estimate projected that inflation will increase in December.
almost everyone was saying
Yes,
the
yes,
same thing.
Yes.
So I think where I'm really driving at is that, would you perhaps have held, you know, the MPC would have held, because that's the thought of some people, that hold this, since there was no inflation, higher inflation rate in December, you can as well have held it, that perhaps the 16.5% decision you took in November will still be able to permeate the system. This is a January where demand is a bit not as strong as December. I hope you are getting
I get it.
the drift.
Absolutely, absolutely. Yes. Those thoughts, it's like your MPC member. Those thoughts also came up in the MPC.
Okay.
And there were MPC members that strongly stood on that position. Yes, we are seeing the so hold fire, pause. Let's see how this will go. But there are also those that say that if you see this, there are a lot of uncertainties around development in our domestic economy, because external influences play a big role. You know, COVID came, was not a domestic issue. Russia-Ukraine war came, was not a domestic issue. The tightening that was occurring in the United States and was not a domestic issue. So we see those external influences playing a big role within our domestic economy. And those uncertainties you may not be able to predict, except, you know, you just see the numbers that are coming out and do your own simulation and say, in the event that it goes this way, this is what we'll do. If it goes this way, this is what we'll do. But the point you made is quite understandable, because even if you hold, you're still tightening, because you're already
because the interest rate is high.
Yes, it's high. So you are still in a tightening mode. But you also know that central bank also give forward guidance in our monetary policy. Forward guidance in the sense that we want the investors, the public, to also be able to predict where the policy directions will be, so that you can also take investment position. We want to guide that investment position of investors. In our inflation numbers, we also look at what we call inflation expectation index. What are people thinking inflation will be? That informs their behavior. You know, that's the behavioral estimation of inflation, apart from the CPIs that you use. It plays a very big role. So we use this same
inflation expectation.
Yes. Yes, that's what we call inflation expectation. It's
Index.
kind of a survey, yes. A kind of a survey of investors, households, businesses, individuals, to see corporates, to see from what you are seeing around, where do you expect inflation to be. That thinking of that individual or firm or business or corporate will inform the decision he takes now, or she takes now, or the institution takes now. Okay, I'm planning to go up further. I'm going to build this because this is how much I borrowed my loan. This is the interest I'm going to pay back. This is the price I'm going to sell my goods. If you discount this expected high inflation from it, this will be my return. If that return is below the break-even point, I will have to increase my prices now in anticipation that this coming increase in inflation will erode part of these gains. So it's built into, so we also guide that expectation. So and that gives central bank credibility. That's what we call central bank credibility. So that will give the central bank to, while also signaling using MPR, the monetary policy rate, it will also give a forward guidance. This is where we go. You remember in the last MPC, it was also mentioned, I think you also asked me the question, what will be the next thing if inflation does not go down? What will you do? And we said, well,
yes, I remember. And I said, would you tighten again?
We will tighten, yeah. And I said, if the fundamentals show that inflation is not going down, then that means the tool we're using has not reached its tilting point. So long as we believe in that tool, we'll continue to tighten. And United States tightened like 5-6 times last year. We did only 550 basis points. Some countries, Ghana even did 1,250 basis points, tightening in 1 year. So many central banks did more than 5 times.
Okay, that brings me now to the question. I'm having 2 questions flash before me as a result of what you're saying, but I just hope. The question I want to ask you now is that, you know, central bankers move like teenagers, so to speak, in packs.
Okay. Yeah.
You understand, you know, during that age.
Yes.
So we've seen central bankers now across the world. They are moving like teenagers, with just your explanation now. So is it also as a result that other central banks in Africa, Kenya, South Africa, Ghana is suffering an inflation of 54% or thereabout.
Yes.
So is it also because that central bankers are moving in packs like teenagers? The CBN's MPC is also saying, I think we should also tighten, because even the Fed has given that forward guidance that there would be hikes, even though inflation is coming down. I think it's at 6.5% now, so in the United States. Yes. So respond to that.
Yeah. Like I said, the economy of Nigeria is influenced by a lot of global developments. There's integration, and this integration is even stronger in the financial side. You know, the international financial market, the banking system, relating to the exchange rate and other, you know, investments that you see in terms of portfolio, capital flow, capital inflows, outflow, and inflows. Now, for as long as other countries that you trade with are tightening, for example, the United States, when the United States was tightening, there was a lot of capital outflow from emerging market economies, because return on investment in the United States is a lot higher. Don't forget that the risk premium there is also a lot lower. We could have higher return, but if you discount it with the risk premium, you know, change of policy or any shock from your domestic economy, your fiscal borrowing or vulnerability in those sectors, the probability of paying back those investments, if you build it in, even if you have higher interest rate, you know, they will still prefer to go to more stable economies that your prediction is more or less like 100% certain to move to that economy. So we saw from emerging, even though we don't have much of that in Nigeria, because a lot of those capital went out during the COVID period. So post-COVID, there was no much that would go out except those that really want to stay. So we saw that carry trade. We saw all of the economies also tightening to keep what they have and even attract the ones that are lost out from other economies. So that school behavior, that teenage, you know, syndrome that you see everybody going the same time, is to protect your own economy space, to be more competitive, even if you don't get inflows. You don't lose a substantial part of what, because there's also the negative real interest rate also playing out there. So you need to also keep that space to hold, because all these economies need foreign investment.
So the question will be the race to who will keep investors more.
Yes, yes, that is the competition.
Is it the ECB or the BOE or the US Fed?
Yes, so, or is it the
Nigerian Central Bank?
Yes.
Or South Africa?
Yes.
SARB?
So even we within our space, emerging market, developing economy, we're struggling for that space from funds that will come from the advanced economies or those that will go to the advanced economies. The global space too, United States, UK, Europe, they're also, you know, playing their own game to retain those investments within their economy, because it's also other source of financing or investment that are required that your domestic economies cannot meet. So you need that to even stay, because, you know, huge capital outflows impact on your exchange rate. You start seeing depreciation, and if you can't control that, you devalue. If you are devaluing, it fits into your domestic prices, because you're also import dependent. You're also we have exposures in foreign assets. You're borrowing, the federal government is borrowing, the states are borrowing, the banks of Nigerian banks are also exposed to foreign credit. So when your currency depreciates or you devalue, all those affect the cost of servicing debt for government, increases substantially. The ability of these banks or investors, the medicine that have taken foreign assets, loans, is also impacted. Their credit worthiness or the credit default risk heightens when those rates go up. So you have those bucket of the economy to also look at. So yes, it is a bandwagon effect. Everybody is doing it, but you do it based on the characteristics of your own economy and how you think those developments will impact on you. When we do monetary policy analysis, we do what we call an appraisal of the global economy and the implications of those global development on the domestic economy. And it's based on that that you take your own decision.
Okay. Now, the second question, dovetailing from what you said, and you also repeated it in a way here, is that I would like you to give me the scenario or give me a sense of what happened like in the room when the MPC members were deliberating around the ways and means. Because 23 trillion naira now, I think ways and means advances to the from the central bank to the federal government. That no doubt has also caused some kind of inflationary pressure. I also know that the governor of the central bank answered questions concerning the ways and means. So can you make Nigerians understand that? You know, how considerable is that weight of ways and means on on the MPC not achieving its objective of controlling inflation?
From the central bank side and from the MPC side, we have a fairly different perspective to this, given the numbers we're seeing. Don't forget that ways and means financing is like filling a hole. It's different from where you have, you know, you're already at a level, a threshold, minimum threshold, and then you are building on that. As against you are below the threshold and you are building up to come to the threshold, minimum threshold, where you think building above that is inimical to your growth or to your stability. So we were below the line, the threshold. So the injections or the ways and means financings by the central bank to government. Don't forget also that central bank is a banker to government. If you have a bank, you took a loan, you are in default, and the bank said, okay, because you are in, and maybe the loan is substantial, it's also going to affect, you know, the stability of that same bank. You're a big customer, and the bank will say, okay, you are in default, but we're going to give you this, like refinancing your debt. We're going to restructure so that you're able to pick up, get your acts together, and then start making income so that you can pay us back, even if it's going to be a longer time. It's different, right? Okay, you are defaulting, you are not paying, we're giving you more. You're going to be killing your business and that person. So I'm using that analogy, even though it doesn't match accurately, that yes, government has shortfalls, deficit, borrowing cost, foreign is high, availability of foreign borrowing is also high, and then you also have domestic challenges, revenue inflows are tight. The argument that was there was government has given, or the fiscals have given a lot of optimism in terms of the reforms they're doing around. Don't forget that we have a permanent secretary, Minister of Finance in the MPC.
Yes.
So they've given a lot of optimism of the efforts that have been done by the fiscal authority to boost domestic revenue inflows or other sources of revenue, to block leakages. The PAMSEC was also giving us example of, you know, income you can earn from gaming industry. You know, all this lottery and all that. It's billions of naira. We also have what we call sin taxes, you know, on these beverages and other alcoholic and other items. So they are looking at, there are some that are actually affected by existing regulation, which they are trying to amend and also bring some clarity into the Finance Act. So there are optimisms around the fiscal improving its revenue.
Was there a sense around the 3% of the FRA, that's the Fiscal Responsibility Act, which the federal government is already flouting, as per these ways and means? The the PAMSEC give an idea of, because what is being said now is not being said, it's actually factual. But I understand what you're saying, and even the governor of the central bank didn't mention it. We're a banker of last resort. We're also a banker to the federal government. And your analysis was spot on in terms of, me own you as a where. You know, if I'm in trouble, save me now. Something like that, I understand. But we're also guided by rules and regulations.
So the point why I'm trying to land is, yes, we know that, yes, ways and means above the regulatory guideline or the CBN Act and stuff like that was a concern. Yeah, but even, and that's why I gave the example I gave, if we had not done ways and means, or if we've not done this proportion of financing of government, some states will have collapsed. Salaries will not have been running, because you remember some of those things goes to salaries, and you see what was coming in from oil exports. A large proportion is going to both what do you call this, subsidy, and both also refined product importation. That's also impacting on our FX. Close to 30% of our FX goes to that part of. So if you're not even getting the FX from your own side, the NNPC or whatever, bringing in those returns to government or to themselves, and then what they get is used under recovery and all that, and you have this subsidy. So central bank is part of the government. The central bank.
So what you're saying is that the federal government is in a tight, very tight.
It's very tight. It's like, you know, in normal parlance.
And the central bank is also in a tight position.
Yes, in normal parlance, we say you don't take Panadol for another person's headache. In this scenario, if you don't take Panadol for fiscal headache, fiscal will come and sleep in your house, and you will not be able to go out to go and do your own work. So the economies are interlinked. The sectors are interlinked. So we need to support each other to be able to build a vibrant economy. Don't forget that. So there are also moves to securitize this. So it takes that off the balance sheet of the central bank. And if that is done, those are issues and issued out as bonds or government instruments that will be invested in by the public. Those funds will come in, finance what is the hole in the central bank. And going forward, we will see that narrowing down. If they are revenue-based also, I read recently, you can correct me if I'm wrong, the FIRS in 2022 raised over 10 trillion. That's huge. We're looking at 4 trillion, we're celebrating. You know, so if those things are improving substantially, the deficit in this year's budget is 11 trillion. You know, I know, yes, administrative costs and some of those monies will go to other places, but if those leakages, those loopholes, new reforms, the tax base are improved, and the revenue to GDP ratio or tax to GDP ratio has improved substantially, you see those things narrowing down. Yes, we agree this is a crisis mode, and during crisis mode, some of these optimal requirements collapse, you know, to give that support. It's not that we're giving absolute justification to be doing that. Yes, there are cautious, even if you read the monetary policy communique, there are caution notes to the fiscal authority to moderate on this, to moderate on that, to improve on security, to improve on revenue inflows. And as we get out of it, economic stabilizes, you see everything leaning out.
Okay, Dr. Mahmood, I'm looking at our time, and I know we don't have so much time, and I've not really delved into this. So I would likely invite you again so that we can talk more about these issues, because I just realized I've asked you just a few questions, and questions never finish.
Yes, they don't, particularly from you.
You know, but just before we go, I want you, this last question will be, how do you explain to ordinary Nigerians what we have just said now? Do you understand? How do you explain to a woman in Balogun market now, selling, you know, her wares? How do you explain to a spare parts seller that imports spare parts? How do you explain to a woman that sells boli, roasted plantain, that people will be blaming her that, do you buy your boli in FX and all? How do you explain to these categories of people? How do you even explain even to the bankers that their customers are owing loans, that whatever the MPC did is in the interest of the country? How do you convince people?
The banker side is very easy, because at least
they will increase their
their elites, and they can see the numbers.
Interest rates will be high on loans that they've given out to businesses.
The bankers actually understand it in the sense that
the businesses.
Yes, because you see, in economics, there are compromises.
Give and take.
Yes, the three musketeers, you cannot hold inflation, exchange rate, and interest rates simultaneously to say that you want to control those factors simultaneously. And so you look at which one is the most efficient pass-through to the others. If it is inflation, you say, okay, there's a huge pass-through from exchange rate to inflation, or from interest rate to inflation numbers. You look at which tools do you have, one, the effective parameters to hold, efficiently, allowing demand and supply to play, of course, and be able to influence the behavior of other prices. And the argument is that, yes, we know that there are rigidity in the pass-through of MPR. It's more or less a signaling tool. So if we do MPR adjustment, we also do, and that informs some of the interventions and moral suggestions we do with banks and some guidelines we give to banks and other reforms we do around exchange rate. So the point is, if you know that you can use that tool to influence behavior of other tools, you'll be able to, direct the behavior of that tool to influence these other numbers. We have seen that the primary mandate of the central bank is price stability. The elephant in the house now is inflation. It's going up substantially. We know the reasons why they are going up. We're trimming those numbers. But this is an explanation for the bankers. For the public there, the bolly woman and the yam seller, is the fact that this inflation is your greatest enemy, in the sense that the money you think you're gaining, even if you have 1,000 naira return on maybe the ball you are selling weekly, and inflation is going up, and next sales you did, you have 1,005 of the same ball you sold, but inflation has gone up by more than 500 basis points. This your 1,005 is less than the 1,000 that you got before. So you are, and then don't forget that you are using this your gain of 1,000 to buy in the market. So the things you'll be able to bring home for your children and family it will be less. So it's more inimical to your standard of living and your purchasing power. So everything we're doing is to make sure that there's a stability in that level, so that what you earn has more value. If you get that more value, then you'll be able to buy things, take your children to school, feed your family well, still be able to eat meat and other proteins in your meal. So that is the essence of that. But the economy is linked, so everything plays out at the same time.
Yeah. Okay. I think, Dr. Mamu, we'll leave it at that.
Okay.
I don't know if I'm satisfied. I know I haven't dealt so much with
the
with the MPC's communique, but
yeah,
you'll come back again and we'll make Nigerians understand better. But thank you for your insights.
Thank you very much for having me.
All right, I've been speaking with Dr. Hassan Mahmood, who is the Director of Monetary Policy Department at the Central Bank of Nigeria. And what he has been doing in the last 30 minutes or so is trying to make us understand why the MPC took those decisions. Was that exactly what we did? Or I was trying to, okay, we did. Okay, because I was just worried that we were a bit too technical. But but anyway, thank you guys for joining us today. I am Nancy Naji. Be the best you can be and be the change that you want to see. I'll see you all again next time. Bye now.